As we close out 2021 and move into 2022, it's been a bumpy road, but the year has ended better than where we began in some very important aspects, whether it be job recovery or dodging the bullet of higher taxes. I'm Angela Palacios, partner and director of investments here at the center, and I'm going to kick off our quarterly investment update. Joining me in this video are Nick Bogath, portfolio manager, and Jacqueline Jackson, senior portfolio manager. The good news is, for yet another year, diversified portfolios are, in general, beating our financial planning targets, helping you move closer to your goals. In the written material, you'll find some additional information on returns and some perspective around them. I'd like to take some more time here to discuss inflation, as that's on everyone's mind right now. I know we've all felt it at the gas pump or at the grocery store. It's been caused by a couple of major economic changes that were fueled by the pandemic. First is people are flush with cash. We've talked about in the past the government stimulus that was deployed at record pace in 2020. This helped people in need get through some tough times, yes, but it also served to bolster bank accounts for many households. This in turn has fueled spending once the economy opened back up. So the big story has really been the consumer this year, as we've had a lot going for us. Elevated savings to start off with, but also wage growth, job creation, and one of the biggest raises retirees have ever seen from Social Security coming into this year. Next, you have supply chain disruptions with trouble producing goods or trouble moving goods from one point to the next. This has really been the perfect storm for inflation. Higher inflation has forced the Federal Reserve's hand to start increasing interest rates in 2022 and increase the rate of tapering of bond purchases so far this year in 2021. In the written commentary, I go into more detail as to why raising interest rates can help check inflation, so check that out to learn more. But looking ahead, we don't expect the level of prices to go down, but I do think the rate of price increases will start to back off. Supply chain disruptions won't last forever as more capacity is brought online. With that, I'd like to hand it over to Nick to talk about market valuations.
A concern we've heard a lot lately is stocks are so expensive, is now a bad time to buy, or maybe we should hold off on investing because valuations are high. While it may sound logical on the surface, history shows that staying the course leaves investors better off more often than it doesn't. Just look at last year for a perfect example. By many metrics, stocks were even more expensive at this time last year than they are today. If you chose to wait for a better time to buy the S&P 500, you missed out on a return of over 28%. Beyond our long-standing discipline at the center to avoid market timing, historic data shows that valuations actually don't predict future returns, especially in the short term. Expensive markets have just as good of a chance to be positive in the following year as cheap markets do, so be careful using valuations to justify sitting on the sideline. Also, when people in the US say stocks, they usually mean US large cap stocks, one asset class. And yes, those are currently at high valuations compared to history, but there are plenty of stocks you can invest in that are not expensive or maybe even cheap in your portfolio. Some international stock markets or small cap stock markets are good examples of this. And lastly, if you are diversified and you have a plan in place, don't let an expensive market scare you from investing. A diversified portfolio will have many asset classes in it. Some will be cheap, some expensive, some swinging for high returns, while some are there for a buffer in case of losses. These will all zig, zag, and work together to hopefully provide the growth you need to have a successful financial plan.
Hi everyone. Now that we've discussed what happened in 2021, let's talk about what we expect to see in 2022. We will likely see interest rates increase. So I bet you're wondering, what does that mean for my portfolio? Well, it means that in your portfolios, we're favoring shorter duration bonds. Keep in mind, we want your bonds to behave like bonds, and we want your stocks to behave like stocks. In other words, your bonds should dampen volatility in your portfolio, while your stocks should help you achieve greater returns. So, no modern reporting is complete without talking about the pandemic. So let's go ahead and address it. As immunities build and the virus continues to hopefully evolve into weaker strains, the CDC is relaxing quarantine guidelines. That's good news for investors because it should hopefully relax supply chain disruptions and help alleviate transitory inflation. Overseas is a bit of a different story, as outbreaks have created sporadic shutdowns with supply chains. But again, if we continue to see virus resolution via immunity or weaker strains, that may help build stronger rallies with overseas markets. Now, while that concludes my forward-looking assumptions in 2022, we do have more to share. We will be hosting our annual 2022 Economic and Investment Outlook event in February. Please stay tuned for details in upcoming weeks. Remember, we are here to help you, so don't hesitate to reach out to your investment team or planner for support. Again, from the center team and the investment team, happy 2022.